everyone. A very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is the show dedicated to all of your personal finance related questions and queries. And as always, we take your questions and queries right to personal finance experts. Today we're going to be discussing two topics. Firstly, markets, of course, have been volatile, as is the case whenever we do face a crisis, and that's really been the case now as well. So, in such a situation, where should those individuals who don't have much of a risk-taking ability invest? I'm talking particularly also senior citizens. Banks as well are offering very low interest rates. So, which exactly are the pockets or the investment opportunities for senior citizens wherein they can earn a bit extra return, but at the same time are not subject to the kind of risks that sometimes equity markets throw up that they cannot afford to take. And later on the show, we'll be talking about arbitrage funds. Today, or rather, an Economic Times report had suggested that a couple of mutual funds had written in to unit holders saying that this time around it's going to be a tricky situation for arbitrage funds. They may not be able to deliver good returns, but we are going to get on board one such arbitrage fund. That's Edelweiss. Radhika Gupta, she herself will be joining us today and clarifying on that front what the future is for arbitrage funds, who is it meant for, what should be the time horizon you should keep in mind before you consider investing in arbitrage funds. All of this on this action-packed edition of The Money Show today. But first up, let's take on board the very first topic, and this one's dedicated to senior citizens. So if you're a senior citizen or if you're looking for investment opportunities for your parents or your grandparents, this is the episode for you. Let me bring on board Kalpesh Ashar of Full Circle Consultants. Kalpesh, always a pleasure having you with us on The Money Show. Good evening. Equity markets have been volatile, and I'm sure you'll agree with me that for senior citizens, some of whom may actually be depending on this investment income to get them their essentials or their day-to-day expenses, to help them meet their day-to-day expenses, maybe having a big exposure in equities, leave alone individual equity shares, but even mutual funds may not be the most prudent option, because any which ways they have been quite volatile. So if you could just start off with that, what is your opinion on senior citizens having an exposure to equities?
See, Mubina, the situation in which we find is completely unprecedented on all counts. And very frankly speaking, the way things have panned out on the equity funds and to say debt funds, I think least to say is really quite worrisome for everyone, and more so for the senior citizens, because they have been hit badly. In the equity side, the valuations have taken a toll on their NAVs, thereby the values have eroded and they have taken a knock. But more worrisome for them is what has happened to their fixed income space. And in the debt funds also, we saw a lot of accidents happening, mishaps happening, which has actually shaken up their confidence. And apart from that, the remedial actions which the RBI has taken, or the economy needs such actions, is that the interest rates have come down, which has had a double whammy on the bank interest rates coming down and the corporate FDs coming down. And it's been a hit for them everywhere. So about their exposure in equity per se, what I would suggest is that they should just sit tight right now, and as far as possible not panic, because as per the financial planning parlance, we've always said that equity in the non-conventional manner, you need some part of equity even in a senior citizen's portfolio, but how much and which type of equity you require is more paramount importance. So if the senior citizens are having good quality large cap stocks, dividend yielding large cap stocks, or they are invested in, say, index funds or something like good multi-cap funds, they need not worry. And the worry, I think, aspect right now for them is generating regular income and making sure that the security in which they have invested doesn't erode. Because whenever I think we open our eyes every other day, there is some bad news on the anvil. So equity for senior citizens, I would say, don't take more exposure for sure. This is not the time to be adventurous for them. But whatever they have, if it's quality, they should try to sit on it. And I think the repair work or the more action-oriented work needs to be done on the debt-oriented or the fixed income side.
Yeah, Yeah, in fact, just last week we had done this entire conversation, for those individuals who had been saving up for retirement, they had accumulated a nice corpus of funds, and they were all set to perhaps break into that piggy bank, but then lo and behold, you had the coronavirus crisis that sort of eroded the value, a significant chunk of their, mutual fund corpus. And that's when they have, that too at a time when they have to retire. So yes, you may not be facing a loss as such, but the value of the fund has definitely depleted quite a bit, and that can be pretty disappointing. That's a conversation we had last week as well, and it's sort of a problem that lingers, especially for senior citizens, because they are the ones who would have a relatively limited amount of time to recoup from this crisis as opposed to younger individuals. Okay, so equity exposure should be limited. But then let's say if you're limiting it to 10%, 20%, 30%, the balance 70, 80, 90% still has to be invested somewhere, right? You cannot sort of have that money lying idly in your bank lockers or your savings account, which earns you a meager 2 to 3%. But Kalpesh, now the problem is that even your savings schemes account, because of the crisis that we are in and because of the fact that the government had to slash interest rates, even savings schemes now don't offer very attractive interest rates. Yes, maybe a PPF still offers a relatively modest 7%, but otherwise fixed deposit rates, which have up until now been a senior citizen or a traditional investor's favorite too, has seen a sharp dip. So Kalpesh, where would you recommend senior citizens invest?
You're right, Mubina. It's a double whammy for them. But I think they'll have to live with the fact that we are in a low interest rate earning scenario for quite a time to come now. But all is not lost. And let me tell you a couple of pretty good options, which I'm sure many senior citizens would be following. And for those who have not followed, I think pretty quickly they'll have to take action on this. The first one is the Pradhan Mantri Vaya Vandana Yojana. It's a government-backed pension scheme which was introduced a while back, but it had a good, I would say, refurbishment done to it in the last time when it was there. The amount per individual was doubled to 15 lakh rupees per individual. That's the outer limit. And the heartening part that time was it was offering 8% for a straight 10-year time frame. Now, unfortunately, that got over on 31st of March of 2020. But the good news here is that the government immediately sprang into action and extended it for another 3 years now. So that's the good part. But obviously, they have to take cognizance of the fact that the interest rates have come down. So the new, I would say, new look Pradhan Mantri Vaya Vandana Yojana has got an interest rate of 7.4%, which is pretty good. It offers a monthly payout option, and the outer limit is obviously fixed at 15 lakh. And the good part here is it can be for senior citizens as a couple. So if a couple has the wherewithal to invest, the husband and the wife, 30 lakh of rupees can be very safely invested in Pradhan Mantri. It's a government-backed security, so the guarantee aspect is not in question. And obviously, being a pension scheme, it is taxable, but it is the best security, regular flow of income you can have. And even in terms of some emergency, like a medical contingency or a terminal illness, some part of it, I think at 2% deduction or something, they can have the 98% back with them. But that is in extreme cases. But the best part here is it's for a period of 10 years. Now, going forward, we'll have to see, because we are in a lowering interest rate regime, that per year, if the interest rates are going to fall, are they going to rejig the interest rate? So right now, for 1 year, they have kept it at 7.4. Let's see what happens. But it is a brilliant option for senior citizens. The second best option is, again, it has been on the cards for quite a while, which is the government post office and the small savings schemes. It was a senior citizen savings scheme, government-backed scheme, and offering 7.4%. That has come down a lot, because when the governments lowered the interest rate, it took a drastic hit. It was around 8.6 last time. It fell by 1.2%, and now it's 7.4, on par with Pradhan Mantri Vaya Vandana Yojana. This offers a quarterly payout. The time frame for this is 5 years, and you can extend it for 3 years. Again, taxable, the interest what you derive. And like the Pradhan Mantri, if the husband and wife have wherewithal or the capacity to invest, they can easily invest 15 lakh each on their names. So again, a provision for 30 lakh can be made. So between these two schemes itself, a healthy 60 lakh rupees can be invested in the husband and wife's name in government-backed securities at 7.4% right now, which is way above your conventional bank FDs. The only problem here is the liquidity, the time frame. But we'll have to live with it, and we'll have to look at other aspects for some type of liquidity or something when you do financial planning, or look at senior citizens planning for regular flow versus just security. So that is the two options. The third option, which has been overlooked for a long time but now has come into prime focus, is the conventional small savings schemes. And in there, I think we'll have to take a relook, a revisit to that, and look at the monthly income scheme, which is open for all. This is not a centric senior citizen thing. It is monthly income scheme, and as the name suggests, you get a monthly payout. Right now, the interest rate in the post office monthly income scheme is 6.6%. And here, the outer limit is 4.5 lakh per individual. So again, two people, 9 lakh rupees is available for you to do it. So the post office monthly income scheme, after you exhaust all these things, you can then look at the fixed deposits. Now, in fixed deposits, we are hell-bent on looking at only bank FDs. I'll come to that for sure. But there are post office term deposits, which as on today come with that same tenure of options of 1, 2, 3, and 5 years. And here the interest rate, if I'm not mistaken, is around the range is between 5.5 to 6.7. Now, compare all these options versus your conventional bank FDs today, which are hovering in the region of 5 to 5.5%. So SBI or the private banks are giving 5.5 to 5.6 for a 1-year FD. So these are brilliant options. And last but not the least, obviously in the fixed income space, debt mutual fund, very well researched, obviously with the help of a proper advisor, not on your own. You should look at debt mutual funds to have an SWP from a very high quality credit rated fund, and where the paper held is AAA rated paper, duration is short, not more than 2 to 3 years, and the SWP type of an arrangement where you get a fixed amount pre-decided can supplement your income also. So I would suggest that planning is done in such a way that it presents a bouquet of fixed income investments.
Well, lots of options given right there by Kalpesh Ashar, so you can take your pick, of some options that are still relatively giving you a better return. Thanks, Kalpesh, for that. Well, we've received lots of questions and queries as well on this topic from a lot of senior citizens, over the course of the last couple of days. So let's get straight to answering some of them. Our very first question is coming in from Mr. Radhakrishnan. He says that he says that I'm a retired senior citizen aged 67 years. I've invested through lump sums and SIPs for the past 6 years, which means he actually started investing in equity mutual funds only in the last 6 years. So that means he started at 61. Anyway, he's put in 52 lakh rupees in various mutual funds. There are 15 schemes in which he's invested. A bulk of it is in large caps, 20%, 11% in multi caps, 12% in large and mid caps, 11% each in mid caps and tax savers, 8% in small caps, 15% in hybrid aggressive, and 9% in debt, which is short term. He has a PPF that expired on the 1st of April 2020, and he's going to get 9 lakhs from that. He's getting a decent pension, and after meeting daily expenses can still save 20,000 rupees per month, so that's good. He does not have a senior citizen savings account. Now he wants to know is that on maturity, this 9 lakh rupees PPF that he'll get, where should he invest it? He's making these savings to spend on leisure trips within and outside the country for the next 5 to 6 years with his wife. So intentions are just like every other retiree, wants to relax, wants to spend the money on traveling. But Kalpesh, he's got 52 lakhs invested in mutual funds, which he started investing in just 6 years ago. Is that the most prudent thing to do? You just have 9 lakhs in PPF, which has already expired, by the way, and 52 lakhs in mutual funds. How would you look at his entire portfolio at this juncture? And would you even advise him trimming down his equity exposure in these times when NAVs too have fallen quite a bit?
A very, very difficult question, but to answer it objectively, I think he's taken a huge amount of risk when he started planning 6 years back by dedicating such a big amount to equities in the first place. So even in his portfolio, if you see, he's got just a mutual fund portfolio. He's got an exposure to debt short-term funds of around just 9%. So I would say just another 4.5, 5 lakh rupees he's put in debt mutual funds out of his 52 lakh, plus the PPF which is there. So that's around total 15 lakh rupees. So it's whatever has happened has happened. Let's look at the remedy now, what he could do. And given in the situation, chin up, he has to face it. The best part is, I think, first of all, to trim down the number of schemes which he has. You don't need 15 schemes in a portfolio at all, be it a 50 lakh portfolio or a 50 crore portfolio. The answer to that is you just need 2 large caps, 2 multi caps, and I would say 1 mid cap to supplement. In the large cap category, stick to 1 index fund and 1 active large cap, so you know where the performance is coming from. Obviously, the actively managed funds, the 2 multi-cap funds you can choose, and a good mid-cap fund which will stand you in good stead. The percentage I would suggest at this time could be, you could look at around 50 to 60% in equity and debt. Now, like you rightly said, Mubina, it will be a very tough call for him to do a rebalancing or shift money to debt. That is a call which he'll have to take. But I would suggest that trimming down of schemes will help him a lot, because that will not dilute the entire portfolio returns. More importantly, now he needs to understand what he will do with that 9 lakh rupees which he's getting from the PPF maturity. The simple answer I just gave in the earlier section, that just put that money right now for the senior citizen savings scheme. You have a limit of 15 lakh rupees. You can easily put your 9 lakh rupees and make that money secure. And in the other part of the debt fund also, I would suggest if it's not doing well, we don't know which debt fund it is. The answer to that is shift that amount also to the senior citizen savings scheme and let it remain. Now you'll have to understand the exit load, the taxation implications when you're removing money from equity and debt funds, so as you don't incur those costs. But genuinely, first, trim down the portfolio to 5 to 6 quality funds. Second, PPF money goes to the senior citizen savings scheme, and even the debt short term, just to avoid any debt mishaps in case it's not a good fund or a high risk taking fund in debt. Also shift that money to senior citizen, and then just wait and watch in the time to come for at least the next 3 to 6 months.
Right, that's the advice. You'll probably have to take some tough decisions, but it'll have to be done, at this juncture. Okay, let's move on to our next question. It's coming in from Ron Coutinho. He also is a senior citizen. He says that he wants to consolidate his portfolio. He's invested in the Mirae Large Cap, Canara Robeco Emerging Equities, SBI Hybrid, Kotak Standard Multi Cap, and Nippon Small Cap. So a relatively smaller fund size. Okay, no, I stand corrected. He's saying that he intends to retain and increase exposure to them by exiting other funds that he's already invested in. It's a whole host of hybrid and thematic funds. So Nippon Hybrid, ABSL Hybrid, IDFC Infra, LNT Infra, HDFC Hybrid, and HDFC Balance. He wants to exit these and he wants to increase exposure in the ones that I earlier mentioned. That's Mirae Large Cap, Kotak Multi Cap, etc. Goal is to create wealth over the long term, can stay invested as I get a pension income coupled with investments from fixed deposits for his monthly expense. Need advice if it makes sense to exit at this juncture on the premise that I'll be re-entering at the same time. So exiting at low NAV and buying again at low NAV, is that a prudent option? Well, I guess it makes sense, but yeah, Kalpesh, what's your opinion?
The theory-wise makes sense what Mr. Coutinho is saying, but let me, have a very a quick remark here that what Mr. Coutinho has decided to do is absolutely spot on, and I'm quite surprised that he's taken this decision of exiting certain set of funds, or he's even named those funds, which I would not like to repeat. But the decision is spot on, and to add that much, redemption proceeds, what he comes out of that fund into the funds which he's selected. So the choice of the funds which he's fresh selected for adding on to the exposure is perfect. And the choice which he's made to exit is also near perfect. And I'll give you a reason for that, because the funds which he's decided to exit are more or less based in 3 categories. One is the hybrid aggressive category, and I'll give reasons for that. Second is the dynamic asset allocation fund. And the third is the thematic fund, which is the infrastructure fund. So all these funds presently in their own way have taken a hit because at least the hybrid aggressive and the dynamic asset allocation have just taken a knock through the roof. And the hybrid aggressive category, especially because in the debt category, in the debt component of the hybrid fund, if you see the 35% or 40%, the schemes have not taken a very prudent call in terms of credit ratings or duration, because by regulatory, I think it's a regulatory issue that there is nothing mentioned that how much could they take an exposure. Now, because of that, the NAVs have taken a huge hit because of the debt problems which have surfaced at various levels. So coming out of hybrid funds is a good thing, hybrid aggressive category, I'm telling, and that would apply even to the previous caller who had some hybrid aggressive component come out of it right now, because the hybrid aggressive fund is not doing its job it's supposed to do. It's better to macro manage and keep debt and equity separate on your own. So that is one. The dynamic asset allocation category and the one fund which he's mentioned is not really adherent to the pattern in which the fund is supposed to move. And finally, the infrastructure story with the thematic fund, better come out of it.
Sure.
Be transparent in what you're doing with the funds which you mentioned, which is a large cap, a good multi-cap, a good mid-cap and a small cap. That will do the job for you.
Okay. Okay. Kalpesh, we're out of time, so we'll have to just stop you right there. But thanks so much for joining us today on The Money Show and helping our senior citizen viewers out with their questions and queries.